Hey everyone, David Barnett here. Today, we're going to be having a conversation about how to put a price on a business. So, we're talking about business valuation and some of the things that you need to know if you're a business owner and you want to plan for the future and you want to have an idea of what your business might be worth. Knowing who to talk to and how to figure out what kind of evaluation you need could prove to be extremely important. Stay tuned.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it.
Are you a small business owner that's thinking about exiting your business now or in the next few years? My team and I are here to help with our unique zero commission program that we've been using since 2016. We can show you what your business is worth, prepare the package you'll need before you meet your first buyer, even run a confidential online advertising program for you just like business brokers do. And we'll coach you through the whole process, or you can hire us to manage it all for you, including coordinating your whole sell-side deal team. Head over to howtosellmyownbusiness.com to learn about how my team and I can help you get ready by watching a series of videos we prepared that explain each step in detail. And if you're ready or just curious to learn more, reach out to us and we'll get you started or schedule a call to answer your questions. I look forward to meeting you and learning more about your business. Great. So let's talk about business values. I also consume a lot of content out there in the world of buying and selling businesses, and I was listening to a podcast by somebody whose show I really do enjoy. So Ed Meisogland has a show called The Defenders of Business Value, and he recently had an episode number 133 where he interviewed Charlie Stanton, who has written a book about business valuation, and the two of them have a conversation about everything that goes into coming up with a small business valuation. And it was an interesting talk because they discussed all of the different sort of flavors, reasons, and purposes behind somebody needing to put a price on a business. And I thought it was a really great conversation. And it kind of gave me the idea for today's show because, here, me and my team, we do evaluations on businesses as well, but it's usually within a very narrow frame of purpose, right? I mean, we are talking to people about buying and selling small and medium sized businesses. And so when we talk with buyers, we do what we call buyer insight analyses. You can learn more about those over at businessbuyeradvantage.com. And we look at a small business, we look at its cash flow, we do some normalizations, et cetera, et cetera. And a lot of this matches what is talked about here in this particular program. Um, but we do it through the lens of somebody who's going to buy a business where we specifically try to analyze the risks involved in a particular transaction. And then we take into account the resources of the buyer. And then we kind of, we figure out what sort of deal would work for the buyer. So we figure out what the business might be worth, but then we figure out what could work for this individual. And as you can tell there, that's not necessarily in alignment with what the seller wants or what the best interests of the seller are, or what the seller could achieve if they had a complete field of buyers that they could choose from that had different levels of resources, et cetera. But it's a consulting project that works for our client in that scenario, which is the buyer, right? Where we show them this is what other people are probably going to say it's worth. This is what you can afford. This is the kind of deal that would work for you. Here's what an offer might look like. And so the reason why I'm telling that story is it kind of gives an idea of how, if depending on the lens you're looking through, you can come up with a very different kind of number when it comes to discussing what a business may be worth. Now, when we talk with business owners about planning for their future or selling their business, then we're again we're looking at what do we think we could get for this business if it was going to be put on the market and stranger was going to be attracted to it, and we were going to have a transaction occur between a buyer and a seller, right? So we call these analyses most probable selling price evaluations. And if you want to see an example of one of those, if you go over to howtosellmyownbusiness.com and you scroll down, step one is the online training, the new Exit Ready program that we put together. And step two says pricing guidance, most probable selling price. And there's an embedded video here that you can watch where it'll actually show you the process, what the report looks like, etc. We have recently updated that to include a new feature, actually. We had developed for our buyers a special tool called the locus of goodwill tool, which actually helps to analyze where the goodwill in a business resides between the individual owner, the business brand, or the location. And we recently sort of brought that innovation over to our MPSP analyses as well, because increasingly we're doing these MPSP analyses not for business owners who say, I want to sell my business right now, but we're doing them for people who say, I want to sell my business in 5 years, 10 years, et cetera. And the locus of goodwill analysis is really great at kind of shedding a light on where people could do work to help remove some of the problems that buyers might see when they look at their business. And, buyers basically ask two questions. They say, what is the cash flow, which will determine the price that they're willing to pay? And number two, will the cash flow continue after I become an owner? Which is a question that has to be answered with a whole bunch of other stuff. This is where your systems and processes and, where the relationships are, and is there a customer concentration, all that kind of stuff has to kind of be distilled and responded to in order to get the answer to that second question, which is going to be the question that determines whether or not the buyer will do the deal at any price. Okay. So MPSP analysis, what we're doing is we're saying, what is the cash flow and what would a buyer likely value this at? And then we go look in the databases of past transactions that we have and we see what other people have paid, right? And we're just looking at the universe of transactions we know have happened. You know, some people will use that data and just average it, which is not really the way that you use that data. The way you use that data is you go in, you look at the different records, and you say, I want to try to find some businesses that are comparable to the ones that I'm looking at. I want to see what other people agreed to pay. And there's all kinds of stories of what could have happened in those scenarios that is just not transmitted in the data, right? So these are kind of guidelines, they're indicators, they're tells along the pathway, so to speak. And we have to try to interpret those and then also just consider, like, would a buyer do something that just doesn't make sense for them? No, I don't think a rational buyer would. There's got to be some reason or understanding behind why someone would do something. I'll give you a quick example before we get back on track here. So a quick example might be that I look at a very small cafe that doesn't earn much money, but I go in the databases and find out that small cafes like that have sold for 5 or 6 times SDE. And I'm like, you know, so someone would say, why on earth would someone pay such a high multiple of cash flow for a small business like that? And then you check what was the SDE and find out it was $13,000, for example, right? And so basically, that's a business that's sold based on its asset value. The espresso machine, the refrigerators, the countertops, the tables, and chairs, et cetera, added up to a certain price, and a buyer made an offer based on that, which just happened to be, 5 or 6 times SDE, right? So that's an example of how you can't just average the data, which unfortunately we see a lot of people do when we get a chance to look at other people's work. So understanding the process, understanding when the result of the valuation process you're following doesn't make sense, because you can very easily have a methodology for valuing a business, for example, where you build yourself a spreadsheet and you put in all the correct numbers in the correct places and it creates an output, and you could have an output which doesn't make any sense. And we see that in our own shop, because the tool that we use facilitates multiple different methodologies for valuing a business, and we have to know which methodologies are most appropriate for different kinds of businesses of different sizes under different scenarios, right? And so it's not a cookie cutter kind of thing. I put out a book on Amazon called How to Sell My Own Business, and one of the reviews, it was a one-star review, it said, this book is terrible. It doesn't give you the formula of how to figure out the price of your business. And back when that review was published, we could respond to reviews. Amazon has since taken this feature away. But I replied, and I'm like, no, it's not a book about business valuation. It's a book about the process of selling your business, right? But what that reader was looking for is they were looking for A plus B equals C. They just wanted a formulaic kind of methodology to be able to input numbers and figure out what their business is worth. And it's just not that simple. So most probable selling price evaluations, the ones that we do, are based around the idea of like literally what it is, most probable selling price, which means the buyer is going to be someone coming from outside. They're going to negotiate a deal with you. The deal has to make sense for them, which means they have to be able to make money at it, etc. Now, that conversation that I pointed out to you earlier, where Ed interviewed the person with years and years of valuation background. Charlie Stanton was his name. In that interview, he talks about all the other kinds of places that he's doing evaluation work, right? And there's different if credentials out there in the world of business valuations. There's BCA, certified appraisers. There's chartered business valuators, for example, as well. All different kinds of credentials for different people that are putting numbers on basically businesses that have no market functioning feature for determining price, meaning they're not publicly traded. We have no idea what the price of a share is, right? Because there's no transactions being reported. So what are those different scenarios? Well, it could be, for example, a court case. It could be a tax issue. So a parent wants to gift shares to someone like a child, and maybe in order to satisfy tax authorities, a price has to be put on those shares. And we also have to consider not just the value of the business, but the fact that maybe the child is being given a minority stake in the business. And so, do minority positions in privately controlled businesses hold the same value as the control position? Right. So, in valuation theory, like if you don't have the authority to make decisions about the business, then the value of those shares is going to be more limited because basically your interests can be subordinated by the majority shareholder who gets to control the board and gets to control the direction of the company, which could, in fact, end up doing things to the detriment of the value of your shares, right? So that then opens the door to should these shares be discounted. So, there's investment valuations, there's these tax evaluations, there's evaluations for legal purposes because of disputes between entities or like marriage breakdown, all this kind of stuff. We have been asked before to take a look at valuations that have been done for things like divorce proceedings in the legal realm, where lawyers have sent us evaluations saying, "Look, here, my client owns a business, he runs a business, his wife is suing him, and their valuation says that this thing is worth $2 million." And they'll often ask, our opinion, and in some cases, we'll do an MPSP evaluation showing that the business could never be sold for more than about 700 grand. So which price is correct, right? The assumptions and the theory behind the methodology is going to lead to a very different outcome. And so, in that particular case, it's up to the judge or to go through the process to figure out which number is more apropos to the circumstances of the situation. One of the other reasons why I wanted to make this video is we've recently worked with a couple of different people who were looking at business transactions. One was a seller and one was a buyer. Okay. And both of them had other evaluation work done before. So, in the case of the business seller, um, the business seller had gone to their accountant who had some experience with business valuation. And the accountant went through a very laborious process of doing a lot of different work with spreadsheets and ended up telling the business owner that their business was worth between 1.6 and $1.65 million. Now, I'm not going to share it on my screen because it probably should not have been shared with me. But the the when we did a normalization, because we were doing an MPSP process on this business, when we did a normalization and did all the add backs and adjustments, et cetera, we determined that the seller's discretionary earning on this business, which was a restaurant, was $230,000 a year. So 1.6 million, 230,000 a year. Our MPSP evaluation was $571,000. So it was off by almost $1 million in difference between these two valuations. One of the most common comments that we ever get from business owners when we do an MPSP is they will say to me, um, "Oh my God, if I just kept the business for a few more years, I would have the same money." And the answer to that question in every circumstance is absolutely, you are correct, right? It usually does not ever make sense to sell a good, profitable, cash flowing business. It really doesn't, right? And this is because the valuation multipliers tend to be quite low for most small Main Street businesses. But the question was, what could we sell this restaurant for? And so we looked at the data available to us. We looked at what other people were paying for similar kinds of restaurants, and we came up with a price of what we thought it could be sold for, which was a big departure from what they had been told. Now, as you might imagine, this seller was not very impressed, right? They and what do you do? So, would anybody and I'll tell you the process we went through was we said, "Look, most sellers don't think the number is enough. They think the business is worth more to them, right? And if this person was 15 years younger, um, could you argue that running this business for 15 years would make it worth more to you? Maybe even worth $1.6 million? Maybe. Maybe you might feel that way, but that's not the scenario that we're analyzing with the most probable selling price evaluation. Here's the problem is if you're trying to make some kind of exit plan and you're actually trying to plan your retirement and you actually want to make the sale of your business part of the function of whether or not you're going to have enough income in retirement to support yourself, right? Because in this scenario, this $1.6 million valuation, which ended up being 13.66 times. Um, so hang on. The Let me make something clear here from my notes. So the accountant ended up using what they called a normalized cash flow, and their normalized cash flow was 117,000. So they arrived at a different cash flow number than I did. Theirs is more of an EBITDA number, but to come up with what they called a normalized cash flow of 117,000, then to say the business was worth 1.6 million, meant that they were saying that the business held a PE ratio of 13.66. So 13.66 times this cash flow is the value of the business, which is like traditionally a like stock market valuation, right? If you're familiar with PE ratios and the history of PE ratios, you could probably find many companies on the stock market right now that might have a PE ratio of that amount. I think the average right now for the S&P 500 index is for average for all the companies is about 20, right? So so this is more in line with that kind of value, but the problem is that small businesses do not have the same kind of liquidity as publicly traded companies. So this business owner though, here's the problem is their expectation about the value of their business has been completely skewed because they then start to act and behave as though they have a business worth 1.6 million, believing that at some point they can sell it to obtain 1.6 million dollars and that they're going to be able to take that money and add it to their retirement plan, which is not going to work. We ran into a similar scenario when we were working with a buyer doing one of our buyer insight analyses where we looked at this company, and this company would sell and install materials used in housing. I'll leave it at that. And this business had, an average income, and it would go up and down a little bit every year. And in the most recent year, they had a downturn, so sales dropped, and the earnings dropped. And the SDE that we calculated based on the add backs and adjustments and normalizations was only $113,000. So this is clearly a business where it's like the owner owns a job. Like the business is basically delivering a cash flow to them in line with what you would expect to earn if you were the manager of this business, right? Several million in revenue, $113,000 in SDE, not much to to talk about really. So we basically told them we didn't think the business had any value at all. and that if they really thought that the future looked bright for this business, then maybe they can make an offer based on the inventory and machinery and equipment, the assets of the business, and under the right terms, and maybe with a bit of a discount to fair market value. It might make sense for them to basically use this as a platform to get into that industry because, again, buyers buy cash flow, right? The So we coached the buyer to make this offer, and the seller responded by sending us an evaluation that they obtained from somebody who comes from the investment community. And they basically used a discounted cash flow methodology to determine the value of the business. And they used a growth rate showing that the sales of the business would go up and to the right, and that the cost of goods sold would remain constant, and that all of the overheads would also remain constant. So they were predicting that after 5 years, this business would be able to grow its revenue by 50%. Keep in mind, they handled materials and they had staff, but they were going to increase their business by 50%. And the overhead, meaning the office staff, the facilities, all this kind of stuff was going to remain constant. So the assumptions in this whole thing are off as far as I'm concerned. But this is a person with a lot of letters after their name. So this person commands a good deal of authority and can present themselves as an expert, and was very convincing to the owner of this business that, hey, I know what I'm doing, right? And so this person then, you know, produced basically these increasing profits every year going forward based on these growth assumptions, and then used a discount rate to bring the value back down to the present, saying this is what your business is worth. And in this scenario, again, we're talking about a business that we calculated a seller's discretionary earnings of $113,000. If sales returned to the previous levels before the downturn, the seller's discretionary earnings would only be about 242,000. So again, 242 SDE is not an incredibly big, lucrative business, etc. This discounted cash flow method gave this business owner a enterprise value of $1.5 million. Again, massive multiple over the cash flow that would be more in line with like a stock market kind of valuation. Did this person apply this methodology incorrectly? The math is all correct. They didn't make a math mistake. I would argue that the assumptions going into it were erroneous, the growth rate, all that kind of stuff. And the methodology itself is erroneous. Because one of the reasons why we rarely ever use any kind of forward-looking methodology when we do MPSP evaluations is because buyers tend to believe that if the business is going to grow and do more work in the future, and they're going to be the owner at that time, that the results from their work should be theirs alone, right? Like, if you think you can grow the business, why would you make that growth part of what you pay the seller? Does that make sense? So most of the time in these small business deals, we're talking about a business owner who's going to sell the business and be replaced by the buyer, who's going to come in and they're going to run the day to day, and they're going to be responsible for everything that happens in the business and any growth moving forward. And so the buyer doesn't want to look forward in their evaluation methodology. They want to look at what's being delivered, which is a business that performs a certain amount of cash flow today. And that's going to be the basis of how they want to examine and value the business. When we do look at forward-looking features at all, it usually is limited to a 1-year forecast based on year to dates. So, for example, around July in any given year, we'll be looking at those year to date financials if the year end is December 31st, and we'll say, here's the performance in the first half of the year. How does it measure up with previous years' first 6 month performances? Are we on track to do this or that? And then we will forecast what we think the year will look like based on the half of the year already being done. And then we might put some weighting on that year because there's all indication that the current year is going to perform to a certain degree. So that's usually the extent of our forward-looking analysis if we include it at all. And it's usually based on some real evidence of how the year is going to turn out. So I just wanted to have this conversation because when it comes time to putting a price on your business, like most business operators are people who have started a business. they've grown the business, they run the business day to day, they make the most senior decisions, even if they aren't the day to day manager, and they're experts about the business, but they're not necessarily experts about how to value or sell a business. And so they'll go and look for help to determine, what could my business be sold for? What are the options when it comes to exit of this business? And what can I expect? How do I make a plan? And so they'll go looking for experts. And if you go and meet the wrong kind of expert, or you become convinced to participate in the wrong kind of evaluation, you could get a perfectly good, correct result that will not be appropriate for your purpose. Okay. So recently I was over, actually, I was invited to come to Newfoundland where there was a exit planning workshop session with some business owners. And some of the business owners said to me, like, I was, we're planning dad's exit kind of thing. Um, but it's like we're being told a business valuation is like $15,000, and that's from someone who's, like, certified in a lot of these business valuations, which would be appropriate in a legal setting, or for tax purposes, or to have someone prepare it who then can show up in court or whatever to argue and defend the value for those kinds of reasons. But an MPSP evaluation is just a few $1,000s, and it's a relatively quick turnaround. It's not an overly in-depth process. It does not result in a 100-page report, for example. If you want to see an example of what it looks like, head over to howtosellmyownbusiness.com. And like I said, there's a video there that gives you an idea of what these reports will look like. It's embedded right there in the page. And This is almost the end of the year. So if you're thinking about potentially exiting your business in the next couple of years, one of the things that I always recommend that people do well in advance of a decision to actually sell the business is to go through this process. Like, have us go through your financials, set you up in our model, do the normalization, determine the most probable selling price, do that locus of goodwill analysis that I mentioned, and then meet with you and go through the report and show you what we think the business might sell for and why, and the things you can do about it, right? So one of the things that we do in the MPSP analysis, if we're able to, if you're in an industry with a lot of data available to us, is we'll do some benchmarking analysis and we'll show you on average what other people in your industry are doing as far as gross margin, percentages, different overhead percentages, et cetera, and show you how you compare. Because if it turns out that your margins are off compared to your peers, and you could maybe work on that over the next 2 years, like a 2% increase in your gross margin is gonna mean 2% of revenue goes right to the bottom line. Now apply a multiplier to that, and you start to see real growth in the valuation of the business. And if all it takes is changing the way you bid or changing the way you put prices on things or changing the way you purchase, then it's something you can work on that will have a tangible effect on the value, not just when you sell, but as you implement those changes, you end up with a more profitable business. And like I've said many, many times, the sweet thing about owning a small business is never the exit. Everyone's always disappointed by the exit. People always think that they should be able to sell their business for more, but it just doesn't make sense for the buyer. The real sweet spot about owning a small business is in the ownership and operation. It's the years you own it and you have profits and you take those profits out and maybe you invest them elsewhere, right? You start to set yourself up with other kinds of investments as a plan B in case something happens to your business. Businesses are privately controlled small businesses are the riskiest asset class there is. So you take money out of the business, you get it into other things. Um, Today is the time to start. And it is December. We usually get these projects done in a couple of weeks, but you can hire us. You can pay for it today. It will be an expense for you in this tax year, which will lower your tax burden. But when you go to sell your business, this would definitely be one of the things that would be added back as a one-time expense because it's not related to the normal operations of your company. So it won't affect your STE or your EBITDA. Anyway, hope you enjoyed that. I will see you later. And again, if you want to learn more, head over to howtosellmyownbusiness.com. That's where all of the stuff related to how we work with business owners and helping them prepare for sale is located. And I will see you next time. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I've prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.